Right now, a fundamental shift is underway in the cryptocurrency markets, a shift that could be one of the biggest money-making opportunities of your lifetime, certainly of this decade. A shift so fundamental that it could totally change your financial destiny forever if you play it right and give you the financial freedom that you actually desire. In this video, I want to lay out exactly why I believe that this is the case and that this bull run is going to blow everyone's minds. So first and foremost, where are we right now in the markets? I believe that this is the earliest stages of the bull market, not the insane mania blow off top bull market phase. The earliest phases. Right now is when the big money gets made. I believe that the asset prices we are seeing in 2023 will probably be the last best chance, the last year, right? Not saying tomorrow or whatever, but the last year to buy many of these top coins at these kinds of prices. Now, the question I have for you is, where do you think we are in the current market cycle? Well, take a look at this. My personal belief is that we are in the disbelief stage. Now, stage 11, that was probably when the FTX collapse happened. Stage 12, depression, that was December. Pretty sad time in the crypto markets. Look, markets go through cycles, and buying low and selling high is basically the only way to win at this game. Here's the sad truth though. Most investors only buy at stages 5 and 6 during the euphoria times when it feels safe. But that's actually the most dangerous time to buy. And very few investors buy at the lows, around stages 11, 12, and 13. Yet that's actually the safest and historically, of course, the most profitable time to be entering into the markets. The people buying now are the ones who are going to be selling to those who only enter late in the cycle when all the euphoria and stuff kicks in, having that false sense of security, actually taking massive risks. Now let's talk about the money cycles. You see, one of the biggest leading indicators for market cycles is actually the flow of money, the flow of global liquidity. So as you can see here, global liquidity bottomed out November 2022, right around the time of the FTX collapse, and of course the low for Bitcoin. Fascinating coincidence, isn't it? That is when China, of course, started pumping money back into the system. China started reopening and just dumping truckloads of cash into the economy. A few weeks later, Japan joined them, buying up truckloads of bonds as well. China is still pumping money into the markets, by the way. And if you want some more evidence, here's a chart showing the Chinese credit impulse reversals. The bottom for Bitcoin has basically always coincided with a bottoming of the Chinese credit cycles. Again, this metric just bottomed, and now we're seeing it start to move higher. Likely, of course, marking a cycle low and the start of a new money cycle, which could lead Bitcoin much higher. Now let's discuss what I believe are the two really insane trends to watch that are really just, in a sense, all you need to know when it comes to how crazy the next 20 months are going to be and are going to send the prices for crypto just sky high over the next few years. Look, first we have to look at the supply of Bitcoin. You see, we're in a new era right now. This chart here shows that we are now in a post-peak Bitcoin world. That means the amount of Bitcoin on exchanges peaked in March 2020 when the COVID crash happened. We are never going to see that amount of Bitcoin on exchanges ever again. Stand by the statement. Since that time, the total supply of Bitcoin on exchanges has slowly but surely been trending downwards continually. We went from 3 million to almost 2 million Bitcoin on exchanges in just around 3 years. That means 1 million Bitcoin was bought off of exchanges, taken off, dumped into hardware wallets. The next Bitcoin halving is about a year away, which will cause yet another supply shock as miner rewards are then cut in half, meaning miners are selling half as much Bitcoin every single day. We have BlackRock. They just launched their Bitcoin fund back in August 2022. Fidelity just opened up Bitcoin for its 37 million retail trades. I think that happened in January of this year. Look, we're heading for a massive supply crisis for Bitcoin in the coming years. There's simply not going to be enough for everybody who wants it. Owning just 0.1 BTC, not even a whole Bitcoin, is going to seem absurd in a few years. Next, let's discuss this chart right here. And this chart's crazy. This shows that in 2022, we had a little over 200 million crypto users in total. Some estimate that number up as high as around 300 million. But if we continue along the current adoption trend, then we are looking at 1 billion people by 2025. So let me get this straight. You're going to tell me that another 700 million plus people are about to flood into the cryptocurrency markets in the coming 2 to 3 years, but the prices are not going to spike up astronomically? I don't believe that for a second. Of course prices are going to go up. Look, we are on the road to mainstream adoption. 1 billion users by 2025 and potentially 3 billion by 2030 if crypto follows the path of the internet adoption, right? It's going to become more and more a part of our everyday lives. And I, for one, am not planning on fading hundreds of millions of more people coming into this market. Remember this one simple truth. Most people will not buy when it feels comfortable. It's just that simple. They're going to wait until prices are at all-time highs before they buy, when everyone's talking about it, when the media's screaming about it. And that is actually the most dangerous time to buy, has the highest risk and lowest reward. And if you're smart, that is when you will be selling your coins that you bought in 2023 to the new people who came into the market, cashing out for millions, sailing away on your yacht with your wife and kids. That's what I want for you. I want you to have that kind of success. My guess on the market top for this cycle will be somewhere in late 2024 or maybe early 2025. And look, here's the reality. You either sell then or you're going to watch your bags drop by 99% in the next bear market.
Today I wanted to talk about a Fed bankster meeting a Russian prankster. At first I thought this was a deep fake, Jerome Powell being tricked into a call with Zelensky by Russian pranksters, but it looks like the mainstream media at least is confirming this, that this call in fact took place, and there have been previous calls with the same prank callers. They were able to get Christine Lagarde on the Zoom call or on the phone, as well as Boris Johnson as well. This is one of the problems. Our politicians, our central bankers are much too old. They're much too senile to use modern technology. Did Powell actually take a Zoom call where Zelensky had his video turned off, but Powell had his video turned on? It's very strange. Where's the U.S. government and the Federal Reserve? Are they really this incompetent when it comes to security? There are a couple really funny moments. In this video, the prank caller asks Powell if he could give him one of those money printers, that this would really help out with the war. And Powell jokes that we have one of those, but we keep it in the basement.
If you could, present me a printing press, I would be really happy.
We have one of those, but we keep it in the basement.
Oh, okay.
I know
So
again, I know you're going to be dependent on a lot of help from the West and from the United States, and I don't have my hands on that, in control of that, but I'll always be a voice for supporting you. That's really that's all I can offer you, because it's not our role. But believe me, I support you, and so many Americans do. So many Americans.
The prank caller also suggests that Powell sets up a branch of the Federal Reserve in Kiev. And you think at this point that Powell would realize that this is really a prank call.
okay, or you could also build a 14th bank of the Fed on our territory. So you could be.
We could do that. Let me come back to you on that. Maybe we'll have a reserve bank in Kiev.
Okay, thank you very much. Thank you very much, dear chair.
I think I'm able to forecast liquidity out for about 18 months, which may mean, and we'll have to wait and see, that means I can forecast asset prices going out 18 months. It's a kind of ludicrous idea to think that I could do that, but that's what the Everything Code seems to suggest. And there's a huge article I wrote in GMI about this. But just to give you guys an essence of what I'm talking about. So Brian, if you can pull up the first chart, and this is the chart of the Fed balance sheet against the NASDAQ. You're all aware of this. This is my thesis that debasement of currency is driving the denominator lower. So every time the Fed print, the stock market goes up in kind of nominal terms. But when you actually debase it by the balance sheet, it doesn't go up as much. So if I debase the S&P 500 by the Fed balance sheet, I divide one by the other, the S&P 500 has gone nowhere since 2012. Virtually nowhere since about 2008, when they started the debasement of currency by quantitative easing. Gold has actually given a negative return over that period of time. Real estate is marginally negative, but most people use leverage on real estate, so it's not a fair comparison. But the NASDAQ has done particularly well in crypto that I've mentioned before. So that chart shows you the relationship. If you can bring the next one up, Brian, this is actually global liquidity. And now look at that fit. That fit is staggering. That fit is so good, you can't argue that there is not a very close ongoing relationship. And anybody who says, well, correlation is not causation. Listen, you're missing the whole point. When you say, oh, well, they print money and therefore money flows into stocks, is simply not provable by the volumes in stock markets. What actually happens is the Venezuelan situation where you debase the currency and the stock market automatically adjusts in price. And that's a phenomenon that you see when there's excess supply of money around. And you see it even in your neighborhood. You saw that houses didn't trade at this price, this price, this price. They went from here to here after the printing. That was the change of the valuation of house prices based on the redenomination of assets. So NASDAQ and global liquidity, now the GMI Global Liquidity Index is a combination of the G5 central bank balance sheets plus money supply and other measures. And it's staggeringly good. Now, so therefore, if this is the key driver of asset prices, then all we need to know is what's happening to liquidity. So the next chart reveals a bit more about it, which is the chart of the year-on-year rate of change of that global liquidity index. So Brian, if you could pull up the next chart. So you can see global liquidity came sharply lower. That brought all financial markets down. The NASDAQ, being highly correlated and a leverage play, came down more, and crypto, which is even more a leverage play on liquidity, plus the adoption curve, as is NASDAQ, because technology adoption is massive right now. They came down a lot, but as that turned, so did markets turn. And this is where people are scratching their heads. I don't believe it. The market should be going lower. Can't you see there's a recession coming? Oh my God, can't you see that earnings are coming lower? Yes, yes, yes. The market knows it all in advance, and it already is priced. Now, I've put that out many times, both on Twitter and here on Real Vision, that the markets are forward-looking, and there is this uptick in liquidity was actually forecast by our GMI indicator, our financial conditions indicator, back in March of last year, showing that we would start bottoming and coming up from this level. The economy will follow suit. We're probably in a recession now, and then we'll have the kind of final stages of the bottom of the cycle, and then it claws its way back up again and doesn't become positive, let's say, till the end of the year, where GDP growth is positive again. But we'll have unemployment staying very sticky and prices coming lower, etc. And again, but liquidity is picking up, markets picking up, and if liquidity picks up further, whether the banking situation changes, the regional banks are still on their knees. So I still think that news flow gets worse and the Federal Reserve end up doing something. If not, the economy is going to get worse. The longer they keep rates up, the more probability is they have to cut rates rapidly later. The market picks this up. And so liquidity is driving everything. So once you understand liquidity is everything, you stop worrying about all of the things that you think should work as a model. Liquidity drives everything, not your model, not valuations, not anything else. It's all irrelevant.
And I tweeted, I said, when the FDIC finally approves banks to hold Bitcoin on their balance sheet, everybody will want to buy it, nobody will want to sell it, and you won't be able to afford it.
All paths lead to Bitcoin. All paths. You talk about Jeff Booth's deflationary path, it leads to Bitcoin. You talk about QE infinity and stealth QE infinity and this BTFP, which, by the way, BTFP, backstop the fiat Ponzi. Okay, that's what this funding program is that the Fed has started. Backstop the fiat Ponzi because, very simple, mathematics, debasement is 100% certain. I've never seen a simpler trade in my whole life, and I call it a trade even though it's an investment.
Greg Foss is a credit analyst and portfolio manager who has spoken publicly about the risks of CDS and their role in the 2008 financial crisis. A credit default swap, CDS, is a financial contract in which the buyer of the CDS pays the seller a fee in exchange for protection against the risk of default on a particular debt instrument, such as a bond or loan. In the event of default, the seller of the CDS is responsible for paying the buyer a sum of money equal to the value of the debt instrument. CDS are commonly used as a form of insurance to hedge against the risk of default, and they play a significant role in the 2008 financial crisis. Foss argues that CDS, which are financial instruments used to hedge against the risk of default, can also be used to speculate on companies or countries failing. He believes that the use of CDS contributed to the financial crisis by allowing investors to bet against the housing market and take on excessive risk without fully understanding the potential consequences. Foss also argues that CDS are often used by financial institutions as a way to avoid regulatory capital requirements, which could lead to greater financial instability.
And so I have this thesis on credit default swaps, and you can actually value Bitcoin because, like everyone says, Bitcoin has no intrinsic value, blah, 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 blah. Well, go full circle. And Mike Novogratz, who, love him or hate him, the man is a big man in finance, tweets out today, Bitcoin is a credit default swap on sovereign debt. Think about it. And I've been inundated. Novo, Greg Foss has been saying this for years. Novo tweets this thing out. And I'm like, well, okay, my thesis is getting around because I can calculate the value of Bitcoin using credit default swaps on the United States and show you that Bitcoin should be trading at over $200,000 today on USA debt alone based on insurance prices for that debt. I honestly believe more than ever, the banking crisis that we are going through right now will be reflected in sovereign debt credit spreads. And the value of Bitcoin intrinsically goes up as bank stocks go down. And I can show you the exact correlation using credit default swaps. Hey, you don't have to buy the thesis, but don't listen to Charlie Munger and don't listen to Steve Hanke, who says it has no intrinsic value. They are wrong, and they are going to expire. They're past their best before date. They'll expire. They shouldn't buy green bananas, right? You know the story. It's not happening quickly because the other system is just so big and so ingrained that you can't change it overnight. And by the way, I don't want to change it overnight. And I don't think Jeff does either. We've talked about this network transfer where it's not like a light switch. You turn one off and you turn one on. The network grows in parallel. And I think we're seeing that happen right now. The people that are coming into this Bitcoin community are blowing my mind. I finished reading Jason Lowry's book, Software, which is 400 pages of absolute intense, in my opinion, brilliance. Other people might think it's intense drivel, but please read it because I am blown away by the intelligence of this young man.
So we've seen the usual pumps. So as you can see, things, even today, I mean, double-digit gains on tokens with questionable values still is the same old story to me. So I thought it was an appropriate time to stop just shitting on bad projects and to just share with you guys the checklist that I have to define which projects are actually worth it. So I've always said it, 95% of crypto is full of shit. There's definitely a crypto bubble, and I would definitely agree with those who say it. The problem is that, well, there is a crypto bubble in which 5% of tokens are going to be absolutely useful and very used, widely used, and therefore their actual relative valuation is very undermined today due to the relative low adoption rate which we're in. I mean, so much more adoption is coming down the line for those who actually serve a purpose and have a real use case. Though today I'm going to explain how I do answer these questions. Is this thing really worth it? And I have a clear set of rules that do it. So this is my model. So it is a 7-step system. So step 1, to me, crucial one, is I take the list. I'm going to do it for the first 100 coins in here. And of course, you can extend that to just as low as you want. Number 1 question to me is, have I ever used this thing, or do I intend to use it in the very near future, like couples of weeks or stuff like that? All right, is this something that I intend to use or not? So nope, 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 nope. Nope, 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 nope. Nexo, did use it? Kava, never. DYDX, did try it. Osmo, use it every day. Blah 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 blah. Nope, 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 nope. Oh, yep. Monero did try to send a few transactions to see how good the network was. Not an easy thing to handle, but once you got it, it's pretty damn fucking efficient. Atom, using it almost every day. Chainlink, using it indirectly through Aves, Unis, and the like. Uniswap, Avax, did use it back then, no longer today, but used it. Tron used it as well back then to transfer between 2 exchanges. So this is not the craziest use case, but still use case. Polkadot, never tried, but I know it's a good project. Solana did try once back then, wasn't very convinced with the user interfaces, so I used it to buy a shit coin, took a quick buck on here. and then deleted the wallet, which I see so many people, I mean, saying Phantom is great. I really didn't see it. Okay, Matic, pretty used as well to transfer tokens from exchanges. So kind of a transfer layer, all right, just like Tron. So there are some use cases for this, but I will use one, not both of them, all right? Dogecoin did buy some of that full of shit coin back then, but like I said, absolutely no utility unless you think this is going to be Mars money or whatever shit like that. Could have some use cases today, but I don't nearly think they will ever pass the... Anyway, the other steps will filter out Dogecoin. Cardano never used it. Ripple never used it. Binance Smart Chain using it lots of times. Ethereum, of course, as well. And Bitcoin using it very few times, but... Bitcoin, we don't want to use it. And remember, Bitcoin's actual store of value use case is to have very little to no utility. Like we said, use cases, absolutely number one rule of safety here. If you never use the product, you rather like to question why the fuck do you want to buy it, all right? So number one thing, do you ever, have you ever used it or intend to use it in the short run with a clear use case for you, okay? It's not just like, I want to buy the token, so I'm going to use the thing, okay? So it's really not the way it is. Step two to me is the blockchain shit. So it's really the way it is. You have to answer that very simple, yet no one does it, question. Do you actually fucking need a blockchain for this service? Remember, every blockchain that doesn't serve a clear, simple purpose service is pointless, all right? You should be able to answer whatever that blockchain does in a single word, all right? Like Ethereum, smart contract, okay? Or that's really the way it is, okay? Simple stuff. I need to be able to answer this thing, like Oracle, interoperability, privacy, okay? Easy stuff, okay? That's the way it is, okay? I need to be able to answer in a simple straight line what this thing does, otherwise problem. Once I know this thing that it does, the number two question is following this kind of guideline sets of rules, all right? So this is kind of, yeah, guidelines that will prevent you from buying a thing that doesn't have economic intrinsic value. So this thing is helping me to figure out if this thing truly has a reason to be a valuable project or if this is just full of shit. That doesn't necessarily mean it isn't today and will never be in the future. But the thing is that, well, once again, in a what so distant future, this thing is actually going to have the sufficient market shares and revenue stream to compensate for the extreme cost of deploying a blockchain. Because most of the time, well, you're not going to be able to answer that question. Or it's going to be, yeah, eventually in a distant future. Yeah, you know what? I've heard that a lot. That's exactly the number one narrative, to sell shit to people in a bubble, which means there are lots of people who don't know whatever they're talking about, and you can just basically sell them whatever shit as long as you use the magic world, blockchain, or NFTs, or any of those shit shows that people don't understand anything about. So if you truly want to invest into something or even trade, you need to make sure there are values into these assets. And in order to define that, use case is a good starting point. Number two is to figure out the economic model. Is it viable or not? So, can you articulate a real business problem that needs solving? I would like to say in here, first filter is whatever shitty projects have metaverse in their name or do serve a purpose in the metaverse. Jesus fucking Christ. I mean, they're not even a metaverse today. So can we at least be serious for a second? Anything that is metaverse shit, whatever, just dump it. Garbage, absolute garbage. First, I'd like to see a metaverse. Then we can actually start to talk about it. Okay, so selling future shit at a tremendous bonus today. Good luck with that. Could it have been fixed before blockchains? Most of the problems are actually solved already, which means we have blockchain replicate of existing solutions. Though I don't like. If the answer is yes to that problem, you can immediately switch to this area, which to me is, well, if you have blockchain, why do you need it? The reason why is you need to answer all of the intermediary question, but most of the time, 99% of the time, this is where these things will fail. Does the benefit justify the cost? Okay, the benefits, we all know that. I hope you know what a blockchain is, a distributed ledger technology, and stuff like that. So understand that basically, if the solution already exists, it probably exists in a solution that we call either a centralized or shared database. Okay, which means basically this is a central database or a shared database shared among and synchronized among multiple participants, all right? So that's the way it is. And this system, well, works pretty damn fucking well already, okay? The problem is that if the actual market participants are have ununified interest, which means someone could eventually try to cheat, well, there is a problem. But whenever that problem shows up, 99% of the time in the fucking real world, we solve that problem by introducing a trusted third party, which will look at everyone's activity and say, okay, everyone's been behaving correctly, so the state is okay. And this trusted third party generally brings a collateral on the table to make sure that if it cheats itself, it's going to be destroyed, that collateral, to compensate for the loss in the general shared state. Okay? So that's the way it is. Most of the fucking time, this works damn great. So how the heck do we need a blockchain when all of this just can't work out on its own? Which means either this guy has to bring so much collateral to the table that, well, it starts to question its own values, which means maybe this guy could actually start cheating as well on the whole system, all right? So that's really the way it is. When you cannot even trust a third party, okay, you need to ask yourself that question. Will all the participants need to upgrade and maintain the system? If that's the case, which I think blockchain requires, okay, the thing is, boy, it costs a fucking lot. Let's make it very clear and straightforward. A centralized or shared database system, it's basically, you're going to replicate that database to how many people are actually using it, meaning reading and writing on that database. Most of the time, yeah, it's somewhere like 10 to 12 participants at best, and it's very easy to coordinate. And if there are collateral problems, then we generally use a third party to scroll over the overall activity. And that's it, all right? Though now the thing is, well, in a blockchain version of it, which means you take an existing business and you try to blockchainize it, okay? How to filter out the shit from the actual true value economics. It's exactly the same as if you compare it to the 2000 era of the actual internet. There were tremendous value being brought by using internet on a business. But the thing is that not every business could actually profit from an internet, but yet everybody was buying irrationally everything that has a .com. So in that sense, I totally agree that there is a bubble with crypto. People buy this thing just because there's a blockchain world in here, but most of the time, the blockchain itself doesn't serve any marginal improve in the existing solutions, all right? Which means most of the time, a fucking centralized or shared database does much more than actual distributed ledgers. Otherwise, well, the thing is that you're going to have decentralization at the core. Otherwise, I mean, what's the point of having a blockchain if it's not decentralized? So you're going to have hundreds, thousands of nodes, which means now your centralized database is replicated 1,000 times, which causes just one problem. I'm going to go immediately down this one. It targets a very few limited assets, but if you ever bought into any of these, be very, very careful. Any project that sells a 100K plus TPS, okay, to me, it immediately infringes the previous rules, okay? What are the real world use cases requiring so much collateral to justify 100 transactions per second? I see only one single use case. The stock exchange, which can require high transaction speed at some point in time, like when the market opens and stuff, when the transactions are like flushed into the market at a tremendous rate. Even though we should even ask ourselves, do we actually need that financial system with that many transactions? To me, I don't necessarily agree with that. But anyway, that's the only use case. That's the only reason why I've always said I'm still okay with Solana if it solves its problem, because that seems to me like the only candidate who could ever be able to achieve that someday. But every other fucking blockchain who pretends, I mean, that's how I filter it. I go to the website of that thing. If I see 100K TPS or any reference to high speed and infinite, I delete immediately. Because I know it serves actually no real world use cases. These guys are generally selling you the future of, yeah, but in the future, we're going to need those TPS. I mean, no, we don't, all right? We can eventually need it in 100 different blockchains, which means the cumulated TPS of those 100 blockchains might be 100K TPS, but certainly not under the same hood. Otherwise, same old problem, you're centralizing 100K transaction. If for whatever reason your network isn't stable, you're going to be a centralized point of failure. So, absolute full of shit. 100K TPS, oh Jesus, I laugh out so loud at this. Eventually, 10 years from now, might be a reality, but how the fuck can you sell that to me today? But it is in the end already. If you can figure out it all that far, first of all, congratulations, that's great, but that's still not the end of it. Depending on the remainder stuff, the thing is that you're going to have to separate between hybrid, private, and public blockchain. Understand one thing in here, that private blockchain is something you'll never ever get to use directly, which means those private blockchains are generally used through the help of a front end, which means you will use an application on a centralized front end, which will integrate with a private network of blockchain that interacts with some other private sector entities. Okay, that's how companies could exchange and trade data in a secure way without trust. That is something that definitely has absolutely tremendous market shares. But how do you want to participate in this? Do you really think that private network is going to launch a public token? Are you fucking stupid or what? No, it isn't. So everything that says we're going to capitalize on private... Oh, man, I got a word just coming to my face now. I mean, you probably know which projects I'm mentioning now, who sells the private network adoption and sells a token for it. Jesus fucking Christ, this is a scam, not to say the least, all right? It really, really makes no economical sense to see that project in the top 20 or 30. Anyway, not mentioning any names, but you probably know which one I'm talking about. Public networks are the ones which will sell a public token. And remember step number one, you rather like to be actually someone using this fucking service yourself, because that's the goddamn business model of blockchain, to make the users owning a part of the networks they're using. So be part of it. So I would say these are the things you should go for, all right? So they should be based on use cases and stuff like that, okay? I hope you know that. This is the final cheat show for me, okay? Private networks value capture, not that much, all right? It's really not the way it is. Private network doesn't like to commingle stuff with the public. Though the hybrid versions, I would say eventually some niche use cases, but most of the time private is none of your business. You just can't go there. Though target where you can actually get some value. Public blockchains, that means public service. That means you'd rather like to use that fucking service if you want to be part of it, okay? So we have it, okay? This is step 1 and 2. Step 3 now. Remember, price doesn't necessarily mean value. In order to transform price action into potential relative guesstimate of value, you need to figure out 4 steps. The first one is, you need to have a bit of history, which means, well, value settles itself as price trade over time. So you need at least a minimum threshold of time to consider this asset might have what could be a potential beginning for value. To me, well, that's at least 3 months of trading. I don't trade any token that has less than 3 months of lifespan. This is too volatilely, stupidly dangerous in the first stages. Too much risk to trade anything that has less of 3 months existence. So minimum lifespan to me. All right, the longer the better. All right, then minimum volume traded regarding the official market cap. So if I have a $1 billion market cap and for whatever reason the volume traded is not sufficient, very dangerous red flag to me. All right, that means this is probably a pump. Okay. Though volume related to historical volume. If for whatever reason there's absolutely no volume and boom, suddenly a spike. I mean, you know what it is, pump and dump, Jesus fucking Christ. I mean, no one gave a fuck about this thing until for whatever reason someone started pumping it. So very dangerous stuff, okay? Get the hell out of it. Volume needs to be consistent. Of course, it's not the linear stuff, but you must not see some big spike of volume coming out of nowhere after absolutely new use cases before, all right? They're a big red flag. 5 is there to me to make sure that 3 and 4 haven't been manipulated, because there's one thing that I know for sure is that, well, market making can be very, very painfully kind of exchanging back and forth the same token thousands or millions of times by an exchange, which basically just creates fake volume. So volume can be fakely traded. That's not a myth, all right? That's really a reality. So in order to make sure that you're not being volume manipulated by whatever broker or centralized party there is, you need to make sure that a significant share of the supply has moved. Remember back then, I warned you, below 10% of supply circulating, it's very dangerous. That means the price doesn't correlate to value. That's what I said for Bitcoin when it gone below 10% circulating supply in exchange. I said back then, the prices you see are full of shit. The value just can't be assessed out of these traded prices, all right? And 6, last but not least, all right? Once you've got a significant enough share of the supply circulating with sufficient enough volume to say, yeah, maybe this market cap could be valuable. and you have sufficient history to stabilize prices after the initial ICO or IPO or whatever the fuck you want to call that, you need to make sure with an additional final stage, which is how the fucking supply is distributed. Because you may see 5-10% of the supply circulating, but if that's the same entity controlling those tokens who've made the same old actions back and forth, then actually, well, that's the thing, all right? So you need to make sure that when the supply moves, it moves on a wide range of wallets, which doesn't have interconnected relationships, all right? Because for whatever reason, if one entity who controls 20% of the supply just says, okay, I'm going to create 1,000 wallets, and then with those 1,000 wallets, I'm going to circulate from wallet 1 to wallet 2 to 3 to 4, 5, and back and forth. And I'm circulating this thing around. I can create fake volume with significant market shares moving without you even being able to see it. So the only way to make sure that you're not going to be someone else's stupid liquidity, make sure these 4 steps are there. That means cheating that thing is absolutely very ridiculously complicated to do. All right? That doesn't mean it's unbreachable. It can be like everything. But the thing is, it requires tremendous coordination to do this. All right? So this is, to me, I've always treated that one from top to bottom, from bottom to top, which means I've always checked the tokenomics first. All right? I have a quick look at the volume. If there are some anomalies in the volume, and history first, okay, then volume, but these ones can quickly be erased or flushed away if there are some problems. Then I generally tend to care of 5 and 6 at the same time by looking at the token supply and the token distribution. If at Genesis or close to Genesis, one entity had more than 20% distributed to them without vesting schedule, that's a big no-no, okay? And moreover, if there are centralized entities like the companies or VC investors or the team, they generally take some marginal big shares of the networks, and they need to have very, very long vesting schedule. And if there's ever inflation in that blockchain, they must not be part of it. Otherwise, over time, they maintain their purchasing power, which means they retain their grip on the market. A centralized market, just go back to the initial stuff, all right? If there is a centralized distributed system of value, then once again, aren't the interests unified? And if that's the case, the fuck you need a token, all right? You might need a token between few trusted parties, but in that sense, why the heck are you listing that token in public exchanges, all right? If that's to serve private purposes, the token isn't for you to buy. All right, so what you're buying in here is buying your stake into a system which you have absolutely no use cases. All right, and that means those guys who actually control the supply, who do you think you are for them? The cool third party who helps pumping the price? No, you're generally the fucking exit liquidity, which means these guys control the prices and they can pump, dump, give you this feeling that you have to get in because it's going up or whatever. When they start unwinding 25% of the supply, you know what it does? Tanking everything.
I've provided some links down in the description of this video. And if you found any value in this video, please hit the like and subscribe button below and click the notification bell if you want to be notified when my videos are released.